Hope you have plans. The new year is right around the corner, and investors are bracing for what could be another roller coaster kind of year. Not sure how much we can take. Joining us now, Nicholas Wealth Management President David Nicholas and Strategic Wealth Partners Wealth Advisor Luke Lloyd. David, Luke, welcome. Thank you for joining us. David, you first. What advice are you giving your clients going into 2023?
Yeah, Lauren, we're telling our clients to keep their watch lists ready. I mean, there's a lot of stocks and a lot of different sectors that are showing relative strength, but we're not really seeing a clear buying opportunity right now. If you just look at the major indexes from a technical standpoint, the S&P, the NASDAQ, still trading below their 200-day moving averages. That's not a very bullish signal for stocks. So we think, and this is what we've done for our clients, if you can remain defensive going to the first quarter, we're going to have a much better buying opportunity right around the corner.
Okay, but buying what, David? Or you don't know?
Yeah, and this is where you're going to want to own the sectors that have proven that they can win. We look at sectors like energy, like healthcare. Mm-hmm. We also like treasuries. Lauren, I know this is boring, but we just started our own ETF. The ticker symbol is FIAX. And what it does is it owns treasuries that are yielding about 4.5% right now. And then we sell options on top of it to generate an additional few percentage points. So if you can own things like energy, healthcare, treasuries in a sideways market, I think the markets will be exactly where they are today this time next year. So investors lose time, which is why we want to own things that are paying us dividends and interest.
FIAX. Got it. Luke, what about you? What are you advising clients?
Yeah, so right now we're telling clients that we're bracing for a recession and maintaining a defensive stance. So something similar, right? Look, patience is a virtue, but investors forgot how to be patient. Everyone wants instant gratification now, especially those that are down some money, and a lot of people are down money, right? People forgot patience because patience got you nowhere for a whole decade. It was buy the dip and let it rip for over 10 years. That's cool when rates are 0% and the economy booms, but when you're entering a stagflation, recessionary environment, you need to let stocks come to you, not go out there itching to buy things. So there will come a time when you switch from defense to offense in your portfolio to make back those losses. Now's just not that time.
Oh, well, when is it going to be that time? You sound so depressing, Luke.
Well, I think that time's going to come probably middle of next year. And I hate to sound depressing. I'm an optimist at heart. I really do. But middle to late next year is when you're going to see a lot of economic pain, a lot of unemployment start ticking up to the 5%, 6% area. And that's when you're going to really look to change that offensive stance. I'm not saying you can't buy any stocks right now. You just can't go out there and just chase everything right now.
Everybody's trying to read the Fed tea leaves right now and play the interest rate timing clock. But what is truly the next catalyst to the stock market? You first, David.
Yeah, I do think a lot of investors are thinking we're going to have this big economic decline next year. I just don't see it. I think we're just going to have a blah year for earnings. I know that's a technical term, Lauren, but what I think is we're going to see is just a market that's okay and earnings that are okay. And I think investors are going to be confused. And so I think the catalyst for next year is going to see when the Fed starts to stabilize rates. But we're creating 150,000 to 200,000 jobs a month, Lauren. This is not an economy that's declining anytime soon. So we just think we're in a sideways market, which is why I like energy. You know, I'm a big energy bull, but we think those names are going to do well next year.
And the energy sector is up about 60% this year. Do you like energy, David? Luke, sorry, switch it up. Luke.
Sure.
I do think energy is going to be good for the foreseeable future, especially as we're in a winter here in America and China just reopened their economy. That's going to increase demand. So I think energy is a good spot to be. The problem is that everybody owns it. It's a crowded trade. So I wouldn't be there too long, especially as we do enter into this more deeper recession that I think is going to be coming in the middle of next year.
Fine, but everybody did or still does own tech. David, what about big tech in the new year? Is it cheap enough now with Tesla down 70%, Meta down 75%? I have my list here. Google down 39%, Microsoft down 29%, Amazon down 50%, Meta's down 65%, Apple down 26%. I mean, is it cheap enough now?
Yeah, I mean, that seems like the best shopping list ever at those prices. But we're still saying to wait on that, Lauren. I mean, look, Tesla, we actually took our profits on Tesla last week. It was painful to do it. But I think we could see Tesla under $100 a share. There is a time coming. I think we're getting close. But look, we're just not going to continue to pay these multiples in a year where earnings probably aren't going to grow much. So I still don't think this is the right time to buy. I like healthcare. I like energy in this environment.
So David, you said you would buy Tesla at sub 100. Is that what you just said?
I would. Yeah, we sold it in the mid 100s. I would buy it under 100. 85 to 100 all day, every day. We're putting money back to work in Tesla.
Luke?
No, I'd stay away from a lot of the big tech names because I don't think you're going to see a lot of true capitulation in the market until you see Apple get hammered. Like I said, in this investment environment, you need to let stocks come to you to pull the trigger. When valuations get attractive enough compared to future growth, I just don't think we're there yet in a lot of the big tech names. The stock we just picked up is Aspen Aerogels, ticker ASPN. The stock's down like 80% for the year. I don't know if Tesla or any other EV maker is going to be the top dog 10 years from now, and most EV makers are still too expensive from a valuation standpoint. But what I do know is that EVs are being pushed on us whether we like it or not. So we're going to buy the arms dealer for EVs, and that's Aspen Aerogels.
Got it. David, Luke, thank you, gentlemen, for the time. We appreciate it.